Hey folks, David Frost, my strategic forecast. You're here for another episode of Common Sense Market Analysis. Today is Thursday, July 19, 2018. We're looking at a daily chart of the SPY or Spider, which is the proxy for the S&P 500. So obviously, as you can see, the S&P 500, the Spiders, moved down about $1 today. The S&P 500 was down 11 points. So this is about 1/3%. It's not a big deal one way or the other. You can see from yesterday we hit that gap fill, and today we just sold off a little bit away from it. Maybe it has something to do with options expiration week, and maybe it just has to do with the fact that we found a resistance level at 281.07, the gap fill, and we traded away from it a little bit. It doesn't take my indication that we have more upside coming in this market. It doesn't take that away. It's just a down day. It's down 10 or 11 points, meaning the S&P 500. Not a big deal either way. Here's what I'll say about the important levels from this point forward, and this is really from a more of a short-term perspective. Now, we have a line down, a trend line at 277.15. That's a gap fill. That can certainly happen at any point in time, and again, it wouldn't take the uptrend necessarily off the table. But from a shorter-term perspective, and a number that's closer at hand than the 277.15 is really the low of the candle from the 17th, which comes in at 278.41. I'll just move this over so anybody that wants to see that. 278.41. That's going to be an important level that we have to close above on the daily chart to really maintain the shorter term uptrend. Doesn't damage the uptrend. If we did, I would just like to see the market maintain closing above that level on the daily chart. Can there be a little more downside leading into Friday's activity? Absolutely. Could we see another $1 or so downside in the Spiders, another 10 handles in the S&P 500? Sure we can, but that would stay inside of the low of this breakup candle, so there really would be no trouble on the horizon even if we did come down another $1, even $1.50 in the Spiders. Remember, we're starting to get into earnings season right now. It really began last week, but right now and into the next several weeks is when the earnings are going to come fast and furious. So we had Microsoft report after the market closed on Thursday, and there's a whole plethora of other companies reporting after the market closed today and even into tomorrow morning. So that can certainly have a short-term impact on the major indices. Am I going to get scared away from the market if the Spiders come down to 279, even below that, 279.50 on Friday morning? No, I'm not. I will view that as a buying opportunity unless something else is developing, unless we're selling hard on heavy volume and breaking below the low from the candle on the 17th. Unless we're breaking hard below that, I'm not going to necessarily get scared away from the market. I'm going to view that, at least as I sit here making this video the night before, I'm going to view that most likely as a buying opportunity. It doesn't mean just buy the market with both hands. You have to see what's going on in the morning. You have to see how the market is unfolding and what's developing. But right now, that's what I have in mind if we should take a dip into Friday morning. So that being said, there's really not a lot of change in the SPY or the Spiders chart from what we discussed yesterday and the day before. But what I do want to do is turn over to the intraday 10-minute chart, and there's a reason why. I want to show you something extremely interesting. So as you can see, we had pretty much a back and forth day. We had a gap down, we went down, up, and back down. So that has two meanings to it. A, it's if you can identify specific areas that are important, it can produce one or more trades out of this back and forth activity. It's usually an opportunity for intraday traders when the market has some back and forth activity. I'm going to show you something extremely interesting where there was a buying opportunity this morning. Before I do that, I want to make mention and thank everybody for participating in the comments underneath the videos. They're very helpful to me. They're very helpful to the entire community. And by the way, pay attention to the comments because there's been some interesting comments. I'm going to let you sift through them, but there was a member or at least a viewer that's watching the videos that made a comment and actually hit the market pinpoint based on today's activity. I'm not going to say any more. You know who you are. And I gave kudos to that person because they hit it spot on. And that's what I'm talking about. There's plenty of people out there that have very valuable information that can be beneficial to the entire community. That's why I invite and encourage everybody to participate in the comments and post their own thoughts underneath the video. So please continue that activity. In addition, please hit the like button on the video and share the video with those people you think that can benefit from this information. All right, let's get back to where there was a really fantastic long trade this morning. So listen, we gapped down this morning and we traded down relatively quickly, and you'll see here the low was 279.46. Now, I put a horizontal trend line at 279.46. And the reason why it's important, and traders that have taken the Lazy E-mini Trader course know exactly why this is important and where it comes from. I'm going to give you one hint, and I'm going to leave the other one hanging for those traders that have taken the course. I don't think it's fair to give away tons of information each night. I give you bits and pieces, which is fine, but I'm never going to give you the whole ball of wax. That's reserved for the traders that have taken the time to take the course and learn the information for themselves. So we're back on the daily chart, and let me get this gap fill line off there so I can just clean it up a little bit. The 279.46 is this horizontal line right here. Now, there's two reasons why that was extremely important. You're looking at one of them now. That was basically the former top before we sold off. This was occurring in the middle part of June. So if you look at this right here and look at it objectively, you can see why the market would find, once again, support at that area. Those price levels are important to the chart. The fact that we rallied up to those levels and sold off from those levels, that's the chart's way of telling us that those price levels were important. But that's not the only reason why there was a trade today. What I will tell you is the other reason for that trade at that level worked out not only picture perfect, but to the absolute penny. And when you have multiple reasons all pointing towards the same thing, that's the same thing as three guys telling you you're drunk, and if that's the case, you probably are, so you might as well go take a seat. So when you have multiple reasons all pointing to the same thing on the same chart, and one of them hits to the penny, and this isn't after the fact, this was before it happened. If traders were running the numbers, they would have found this particular price level to the penny. And when you go to multiple different time frames and you looked at the daily chart and you saw that that exact price level coincided with those highs from mid-June, you know without a shadow of a doubt that that's going to be a high probability trade. Is it a guaranteed winner every time? No, nothing is a guaranteed winner every time. But when you have these type of scenarios where multiple things point to the same particular price level, that's an area that you have to be willing to step in and take the trade, and at least you know where you're wrong on the trade. Now let's look at something else, and I do this every single night because this happens every single day on so many different charts. But what do I say all the time? Markets like to come back and test former breakout or breakdown areas, and in this particular case, we had a breakdown candle, and the market rallied all the way back to test the high of this breakdown candle. Now you can use that for two different reasons. A, you can use it to be short the market at that level if you so choose, or you can use it as an exit if you were long from that trade down here, for example. So there's multiple reasons why we use certain particular price levels on the charts depending on which side of the market you're on. And by the way, what did we have up there? We had a pseudo doji candle, and the market sold off from that level. So it goes on and on and on, and if you really want to learn everything in one package, right, and we can all unpack it together, if you take the course, You will set yourself up to learn so many things on these charts, whether you're looking at a stock, a commodity, the spiders, the NASDAQ, the IWM. It doesn't make any difference. All charts act and react the same way. And by the way, folks, don't just take my word for it. Go ahead and read some of the comments under the YouTube videos. In fact, these are just a handful. I get emails by the tens and dozens all day long. But just listen to what other people that have taken the course have said about the course, about what's taught in the course, and about how they view the markets entirely different than ever before. All right, it's enough of that. Let's move on to the IWM. The IWM had a strong day, so let's talk about this for a second. So we had the spiders down about 1/3%, and we had the IWM that was up more than 0.6%, up over $1 in the IWM itself. So we talked about the fact that this was a pullback. We talked about the fact that the amount of time that it pulled back for into the 20-period moving average, and we talked about it the last couple of days. It looked like it was getting its footing, that it wanted to go higher, and today we had a nice move higher. Is this a leading indicator? Well, yes, it's my favorite market leading indicator, whether it's on the up or the downside of the market. And here we have an IWM that was up in the face of the S&P 500, the Dow, and the NASDAQ being down today. Can we read into that? I am reading into that. I think it is a leading indicator. They don't all have to act together at the same point in time. I think this is another shot across the bow. We've seen this before. We've read this book before. We've been to the movie before. And certainly everything can turn around tomorrow and drop through the floor. I get that. The IWM can turn around and have a total take back tomorrow. That's certainly possible. I don't think it's necessarily probable. The IWM is telling me right now that the market is strong. We know the IWM is strong. It's still in an uptrend, as are the other markets. So right now, I'm taking the IWM, my favorite market leading indicator, at face value, and I'm anticipating, as I've been discussing, that we're not finished with the upside across the markets just yet. I'm viewing today as a pullback in the S&P, the NASDAQ, and the Dow. We may have another pullback day tomorrow. It's certainly possible, but I'm not taking the upside off the table until and unless we begin breaking below certain levels, which we're not at now, so we're not going to discuss it. Right now, I'm still viewing this market with bullish behavior from a longer-term perspective. Here's a chart of the VIX, and the reason why I want to bring the VIX up tonight is because I always like to give you both sides of the equation. So the VIX was up today about 6%, so I think it's worth discussing. The VIX still remains below all its moving averages. It's still in a bearish pattern, even though the VIX was up today, and that's rightfully so. The major markets were down for the most part, minus the IWM and the transports, by the way. We'll get to that. So here's the bearish pattern, and this is telling us that there's likely another move to the downside. What we have to realize, or I want you to realize, is whether the market's in an uptrend, any market, any chart, whether it's a stock, the VIX, the market, doesn't matter. If a market's in an uptrend or a downtrend, doesn't mean that we're going to continue that trend every single day. So in a downtrend, there's going to be rallies along the way. In an uptrend, there's going to be pullbacks along the way. So we have to take this from the long view. We have to realize that every day is not going to be in the same direction as the trend. But we do want to note it's a puzzle piece. It's on the table with the rest of the puzzle pieces that the VIX did have an update today, up over 6%. Is it a dead cat bounce? Maybe. Is it still in a downtrend and making a bearish pattern? Yes. Just want to note it, put it on the table. It's a piece to the puzzle. Speaking of the transports, my second favorite market leading indicator. So let's look at this objectively. We have the S&P, the Dow, and the NASDAQ down, and my two favorite market leading indicators up, the IWM and the transports. Well, do I have to say any more? Not to say there's any guarantees across the market, but if my favorite market leading indicators are up on a day when most everything else was down, I have to look at that as a positive. I have to look at that and say, this is the market's way of telling me that the upside is not finished just yet. Now, what's also interesting was we didn't quite close above the breakdown candle high. That number is 10,750.88. Now, let's take a look at where we were. Yesterday's high was above that level, 754.14, and today we closed at 10,747.65, so we still closed below the high of the breakdown candle, but we're testing it. It's important. So technically speaking, as far as I'm concerned, unless we close unless we close above the high of the breakdown candle, the market is still susceptible to go to the downside. It's still technically a bearish wedge pattern the way I look at the market. So let me show you what I'm talking about. So we have a down move, okay, from the highs we have a down move. Then we rally back and we make a test around this high. Okay, we didn't quite get there, and we sell off. Now we have another move, and what do we have here? We have an ABC pattern, don't we? We make a run for the breakdown candle high. If we can't close above that high, this market will go down again. We're going to give it a little bit of time. If we do close above that breakdown candle high, then that means that the market will be in a position to push higher, to push to higher prices. Do we have to make new highs in the transports? We may or we may not. I'm not really concerned about that just yet. My eye is really on the SPY or the S&P 500. That's the market where I do all my work, and that's the market where I've given you the specific numbers on the upside that I'm using as target areas. And keep in mind, a rising tide is going to lift all boats. So if the SPY or the S&P 500 is running to these higher prices, which are considerably higher than we are now, then all the markets are going to be running together. That's just the way it works. Way more often than not. Can we have an anomaly? Of course we can, but it's just unlikely. Here's a chart of the NASDAQ or the triple Qs. It looks very similar to the spider over the last 3 days, right? We had the big up candle. Now we've had a little bit of a pullback, but look where we are in the charts. There's nothing wrong with this market as long as we stay inside of the low from the 17th, that candle, same as the spider, then there's technically nothing wrong with this market, and all this is a pullback in an uptrend. Nothing more, nothing less. Now, an area where we did have poor performance today, again, looking at both sides of the market, it's more puzzle pieces. We have to have them all. The XBD and the XLF had bad showings today. Now, the rest of the markets were down as well, but when you look at the XBD, we were down 1.37%. The spiders were only down 1/3%, and we'll get to the XLF in a minute. That was actually down more than the XBD. So we have to recognize that it was a bad showing across the financial sector, but you have to take it with a grain of salt. We've had a pretty nice rally in those markets over the last several days. So is it just digesting some of those gains? Certainly possible. If it develops into something more, that's different. Right now, I'm just looking at it as we just digested some of the large gains we had over the last 2 or 3 trading sessions. Here's the XLF. So here's what I'll say about the XLF. I don't love the fact that the market really had a failure based on today's close at the moving averages that we closed above yesterday. That's not necessarily a great sign. However, we still held the 50-period moving average, but look a little bit more closely at what we did today. Did we come in to fill a gap that was left open from a couple of days ago that coincided with the 50-period moving average? Yeah, that's exactly what we did. So that gap is right here. So we came in to fill a gap coinciding with the 50-period moving average. Is that all they're going to do on the downside? Time will tell. But that's a possibility that that's just what it was. Is the market just trading technically sound? Well, in large part or in most part, yes, it is. Again, same story with the XLF. Were we just digesting some of the large gains that we had over the last few trading days? That's certainly a possibility. Not in love with the fact that we captured or recaptured the 100 and 200 period moving average yesterday and gave them right back today. That could turn into something more. Time will tell. Need some more time on the clock. We'll see what happens. It will certainly be very interesting to see the weekly close. But then again, we have to look at both sides of the market. Not in love with the financials performance today. More puzzle pieces. Put them on the table, we'll put them all together, and it'll come out with a picture. They always do. Now here's a chart of Microsoft. Before we move on to the other markets, there's a reason why I want to show this to you, and it goes towards sentiment. So when sometimes the sentiment across the market is very negative, you'll see companies when they report earnings, if the stock starts down, they really get hit pretty hard. And what's interesting today is Microsoft stock upon earnings started down. So here's the aftermarket chart. This is an hourly chart, but it shows the aftermarket activity. And you'll see what happened. The market started down. It got all the way down to a low of 102.31, which was the 200 period moving average here on the 60-minute chart just by chance. And then what we did was we had a rocket ride higher off that level, and now we're basically flat after the earnings report. Now, I don't know what the earnings were. I don't really care what the earnings were, but what I'm here to say is that regardless of what the earnings were, if the sentiment across the markets was poor, and the initial move in Microsoft, which is widely owned stock, obviously, if the initial move was down and the sentiment was poor, you would have normally seen Microsoft go all the way down near $100, maybe even lower. But that didn't happen. That tells me in the back of my mind, I'm not using Microsoft as a proxy for the markets at all. It's just in the back of my mind, it's a small puzzle piece. It's a little tiny puzzle piece. But in the back of my mind, it speaks to the sentiment in the market. It tells me that somewhere along the line, there's a bid underneath this market and there's not a lot of sellers out there. Just thought it was interesting to bring that to your attention. Nothing more, nothing less. We're not using it as a proxy. It's not an indicator for me in the markets. I just wanted to point something out on a widely held stock that could have easily went down to 100 or below after earnings. That didn't happen. We're actually now up a few pennies after earnings. So that speaks to, at least from my perspective, the positive nature of things across the markets, at least for the time being. There will become a point in time where that all changes, but I don't think it's right now. Here's a chart of gold. Now, gold may have looked like it wanted to form a bottom yesterday. It was a little tiny tail, and I had some questions about that activity yesterday and whether or not it was a buying opportunity, and I was really shying away from it because I really wasn't sold on the lighter volume. It wasn't a tail on heavy volume. You could call it a pseudo doji candle. I wasn't in love with the whole picture from yesterday's perspective in gold. Now, today, all of a sudden, we have heavier volume. We have a longer tail, we made a lower low, and the market seems to be trying, at least from today's perspective, to put in a low. I'm not saying buy gold. I'm saying I want to see the weekly close, and I want to see if, in fact, we did try and put in a low today. I want to see where the close is of the week. That'll tell me more information, much more than I have right here, right now. I'm not suggesting it's going to be a long-term buy. Gold has been in a pretty heavy downtrend for a while, but it could produce a tradable opportunity. Let's see what happens on the weekly close, and we'll take it from there. We'll talk about it again after Friday's close. How about crude oil? Remember we put in that trend line. We discussed it, 68.75. Look where the high is today. Let me just move this over. The high today is 68.79, and we backed off that level. So from the low, when we hit the 100 period moving average, we put in, and this is September's contract, so the numbers are slightly different than we were discussing the other day, but they really stayed the same. I mean, the chart is the chart. It is the same at the end of the day. So we put in a low, we put in the tail candle, we talked about it, we said you can buy a retrace, you know where you're wrong, daily close below that low from the 17th, and you'd have to be out of the trade, it would be wrong. And so far so good, we've had a nice rally off that level. What's the next major area of resistance? You got it, the breakdown candle high. I don't know if we get there anytime soon, but certainly that will be a major area of resistance if crude oil can get up to that level. I'm not long crude oil. I didn't take the trade down here off the tail candle, off the 100 period moving average. I'm just reading the chart as I see it. I'm more of an umpire in this particular case, just calling balls and strikes. Ever since the short trade from way up here, I covered it down here and haven't got back in the long side of crude just yet. I'm anticipating that it's actually going to put in a bearish pattern and have another leg downward. So that's kind of what I'm waiting to see if that develops. That's what I'm waiting for. And with that, folks, I'm pretty much out of wind for this evening, so I will give it a wrap here. I'm David Frost, my strategic forecast. Thanks for tuning in for another episode of Common Sense Market Analysis. Wait, that was a fake out. I have one more thing to discuss. I promised one of the viewers that I would look at the euro-dollar chart. Well, I'm going to look at the dollar. It's really the same. I'll tell you about the dollar, and the euro is the opposite. So basically, the bottom line is in the dollar, it's bullish. We've been bullish the dollar. I used to cover the dollar every single night, and I really didn't think anybody cared, so I stopped covering it. But those of you that have been around for a while will remember this. We were long the dollar. Remember this line. We were buying the dollar down in this area. I think I had a false start once, and the dollar went a little lower, and I said it's still a buying opportunity, and there were reasons why. I'm not going to go over all the reasons why we bought the dollar down in this level, but I said that would be a longer-term buying opportunity for the dollar. Well, the dollar has already retraced about half of the move, and when I point this out, you'll see what I'm talking about. Half the move from this high down to this low, and we're about halfway home right now. And let me show you a different chart, and I'll show you why I'm still bullish the dollar. When you look at the weekly chart, you can see here that we've basically been consolidating for several weeks, right? As long as we stay inside of this last breakup candle, right? As long as we stay inside that particular price level, then this dollar will go higher, and the next target is where? The breakdown candle high, all the way up here. Now, this is a weekly chart, so it's not going to all happen in one bite, but nevertheless, I still am bullish the dollar. That would mean I'm bearish the euro, and not to say this is going to be it. I don't think this will even be the extent of the upside of the dollar. I think there are still higher prices to come. I am long-term bullish the dollar. Looking at the daily chart, just working backwards, you can see here we have this breakup candle. So as long as the dollar stays closing daily above this particular price level, and we can certainly have some backing and filling here. That's not out of the question. That's common, normal market behavior. But as long as that backing and filling doesn't take out the low down here just below 93, then this is just consolidating to move higher. This is just a daily look at what we just looked at on the weekly chart. So while we can have some backing and filling, the reality is higher prices should be coming in the dollar. And now I'm really out of wind, so I will give it a wrap here. And I will once again thank everybody for tuning in for another episode of Common Sense Market Analysis.